All right, let's dive right into this explainer, where we're going to completely flip how you think about retirement planning. Now, if you're like most people tuning into this, you've probably got a very specific, deeply ingrained fear about your golden years. But today, we're digging into some data that strongly suggests you might actually be worrying about the exact wrong thing.
So, I want you to ask yourself honestly, what is your absolute biggest risk in retirement? For your entire life, you've been conditioned to fear running out of cash, right? I mean, every time you turn on the news, you're hit with these terrifying headlines about inflation or market crashes or whatever the next looming recession is. You've spent decades stressing over whether you'll have enough to just pull off a comfortable retirement. Well, it turns out the data completely shatters that lifelong myth. Studies keep coming out showing us the exact same reality. Your actual biggest risk is leaving behind a massive pile of money you never got to enjoy. Most affluent retirees are simply not spending down their portfolios, which means you're likely on track to leave behind funds you'll never use. And not because you didn't want to use them, but because you just didn't realize you could actually afford to spend more.
Which brings us to the retirement paradox, your savings muscle versus your spending muscle. Decades of exercising your saving muscle makes flipping the switch to a spending muscle incredibly difficult. Think about it. You work for 30 or 40 years. You diligently stash money away in your 401k and you watch that balance climb. Then, bam, retirement hits. Suddenly, the money has to start going out instead of coming in, and it's like a psychological block. According to a 2024 study by the Employee Benefit Research Institute, the numbers on this are just staggering. Only 11% of retirees actually describe themselves as having a spending mindset. Meanwhile, almost 4 times as many, 44%, are still stuck in a savings mindset, and another 38% are holding back specifically for unforeseen costs. You've saved for decades, you're officially in retirement, and yet you're still saving? And all of this irrational holding back, it leads us directly to the consumption gap. It's this massive disconnect between mathematical reality and human behavior. A recent study in the Journal of Financial Planning defines this gap as the significant difference between what affluent retirees could safely spend and what they actually spend. It basically proves that most of these folks aren't even spending their annual investment income, let alone dipping into their actual principal. They've built this incredible wealth-generating machine, but they totally refuse to utilize the output. Get this mind-blowing statistic. Between 2000 and 2008, which, remember, included both the dot-com crash and the Great Financial Crisis, the average financial assets of affluent retirees actually increased. Think about that. That was one of the absolute worst stretches for investors in modern history, yet their wealth was still growing because they were spending so far below their means. So, why do portfolios keep growing? You're probably wondering how that's even mathematically possible, especially since we're basically taught that retirement is the exact moment you start draining your accounts. Let's break down the math. Imagine you've got a cool $1 million balanced portfolio, and you want to use the die with zero philosophy over a 30-year retirement. To drain it to zero, you withdraw exactly $61,000 in year one. That's a 6.1% withdrawal rate. And then you adjust that amount up every single year for inflation. We'll assume an 8% portfolio growth and 3% inflation. Just let that setup sink in for a second. If you map this out over a 30-year timeline, what happens to that $1 million? It starts growing. In fact, it keeps growing for a full decade before it finally hits its peak. And the crazy part, even after it peaks, you wouldn't start dipping into your principal until year 17. Halfway through a 30-year retirement plan literally designed to die with zero, and you haven't even touched the principal yet. Why does this happen? Well, the math literally demands early growth to protect you later on. Your portfolio has to build up a financial cushion in those early years just to cover the higher inflation-adjusted spending that's coming decades down the road. Which means seeing your retirement projection graphs, those Monte Carlo simulations go up in the first decade isn't an anomaly at all. It's perfectly normal. Now, what if you play it even safer and follow the much more common conservative 4% rule? Your portfolio is going to grow for much longer. In most scenarios, you won't touch your principal until the final decade of your retirement, if you ever touch it at all. I mean, life expectancy puts a 65-year-old passing away in their mid-80s or maybe early 90s for couples. And that is right around the time the principal finally starts dropping. So if you don't actually need the money, your required minimum distributions, those RMDs, they just become forced taxed transfers from your IRA over to your taxable brokerage account. Because hey, the IRS always gets their cut, right? Okay. Math class is over. Let's look at the retirement spending smile to really explore the psychology of aging and the true cost of this underspending. Because the real cost here isn't just a slightly bigger inheritance for your kids, it's the experiences you totally missed out on. Researchers David Blanchett and Michael Stein discovered this fascinating curve called the retirement spending smile. Their research actually shows that real spending in retirement declines by about 1% per year on average in inflation-adjusted terms. We just naturally spend less and less as we get older. Think of your retirement life cycle like 3 distinct chapters. You start in the go-go years of your 60s. This is your limited window for experiences. You've got the health, the energy, and the drive to travel and make those memories. Then you transition into the slow-go years in your 70s, where you're naturally staying a bit closer to home. Finally, you hit the no-go years in your 80s. Activity and spending are highly reduced, and honestly, your biggest adventure for the week might just be a trip to the local pharmacy.
And that brings us to the ultimate balancing act of retirement planning: time versus money. To avoid being the richest person in the graveyard, you've got to have an action plan. Step 1. Accept that if your balance goes up in the first 10 years, you aren't doing something wrong or being too conservative. It's completely normal. Step 2. Run an actual cash flow projection. Forget the back of the napkin math, okay? Map out your Social Security, pensions, taxes, inflation, the whole shebang. Seeing the real math is what gives you permission to spend. And step 3, give yourself permission to build in some spending bumps. Picture this: you're 5 years into retirement, and your plan shows your portfolio is actually up 30% from where you started. Seize the moment. That is the universe literally telling you to book the trip, fly first class, take the grandkids to Disney. Convert that excess wealth into lifelong memories while you still have the go-go years health to actually enjoy them. Seriously, you've earned it.
You know, Bill Perkins hits the nail on the head in his Die with Zero philosophy. We are constantly protecting our money, treating it like it's the most fragile thing in the world. But money can continuously grow, even when you're actively trying to spend it, just like we saw in the math. Meanwhile, we carelessly let our truly finite resource, our time, slip away. You can always make more money, but you can never, ever make more time. So I'm going to leave you with this one provocative question to ponder. If you're sitting on a growing pile of money, I know the entire financial industry has pushed you toward caution your whole life. But at some point, you've got to shift from just protecting your wealth to actually living your life. Which dollar do you think is going to bring you more joy? A dollar spent at 65 in Italy, or a dollar spent at 85 on prune juice? Let that guide how you look at your own retirement.